In this video, I want to talk about common methods that private companies use to go public. These methods include initial public offerings or IPOs, alternative public offerings or APOs, direct public offerings or DPOs, reverse mergers and SPACs. Toward the end of this video, I will talk about SPACs and I will explain why are they suddenly so popular. Common methods of going public. The first method of going public is an initial public offering or an IPO. An initial public offering is a public offering through which a private company can sell its shares to institutional and retail investors. And public offering must be underwritten by one or more investment banks. These investment banks also arrange for the shares of the private company to be listed on one or more stock exchanges. And there are some negative points about an IPO. Usually, an IPO is a costly and time-consuming process. First of all, private companies should satisfy some disclosure and reporting requirements. In addition, investment banks usually charge hefty fees for their services. And finally, and most importantly, the success of an IPO depends on the market condition. This adds to the uncertainty that a private company faces when doing an IPO. The second method of going public is a reverse merger, which is also called a reverse takeover or a reverse IPO. A reverse merger allows private companies to go public without raising capital. A private company can use a reverse merger to go public by acquiring a public shell company. A public shell company has no assets and liabilities, but it is listed on a stock exchange. How does a reverse merger take place? First, investors of the private company acquire a majority of the shares of a public shell company, which is then combined with the private entity. However, the shell company can be registered prior to this deal, and because the shell company doesn't have assets and liabilities, the registration process will be relatively straightforward and less expensive. In order to complete a reverse merger, the owners of the private company exchange their shares in the private company for shares in the public company. And as a result, the acquiring company, which is the private company, turns into a public company. And finally, the public shell company renames itself after the privately held company. The third method of going public is an alternative public offering or an APO. An APO is a combination of a reverse merger with a simultaneous private investment of public equity. I just explained what a reverse merger is. A PIPE is when a publicly traded company sells its stock to investors in a privately negotiated transaction. Usually, institutional investors, such as hedge funds or mutual funds, invest through PIPEs. How does an alternative public offering work? First, the public shell company and the private company complete the reverse merger. Then the company files a registration statement with the SEC to register the PIPE shares. And after this registration is filed with SEC, the PIPE funds are released from escrow. and the company announces the completion of the transaction through a press release. Now, an alternative public offering is completed and the company's stock begins trading on the OTC bulletin board. However, after the completion of the APO, when the company's registration statement goes effective with the SEC, the company can submit its application to obtain a listing on NASDAQ, Amex, or New York Stock Exchange. Another method of going public is direct public offering or a direct listing. In this type of offering, a company offers its securities directly to the public. In other words, the company doesn't need to use an underwriter and it can self-underwrite its securities. Previously, companies couldn't issue new shares for direct listings, and usually companies use direct listing to increase liquidity for their existing shareholders. However, on December 22, 2020, the SEC announced that it will allow companies to raise capital through direct listings. In other words, now private companies can raise capital and have an IPO without having to pay huge fees to investment banks. However, a negative point about direct listings is that issuance of new shares can lead to dilution of current shareholders' ownership. The last method of going public that I want to talk about is a SPAC, or a special purpose acquisition company. What are SPACs? SPACs are blank check shell companies that are created for raising capital to acquire an existing private company without going through the traditional IPO process. Why are SPACs called blank check companies? Because investors in SPACs do not have prior knowledge of how the funds will be used. How do SPACs work? SPACs raise capital through selling shares and warrants to investors. Warrants give the right of buying a certain number of shares at a certain point in time in the future to investors. After the funds are raised, they are kept in a trust. Then two scenarios can happen. In the first scenario, after finding an attractive private company, management team of a SPAC uses the funds in the trust to acquire the private company and take the company public. In the second scenario, if the SPAC doesn't merge with a company or doesn't acquire another company within a deadline, which is usually 2 years after raising capital, it will be liquidated. So, why are SPACs suddenly so popular? As I previously mentioned, the success of an IPO depends on the market condition. In other words, a private company may be forced to cancel its IPO due to a bad market condition. However, a SPAC is a much less risky option for a company because in a SPAC, a private company signs a deal with the SPAC sponsor, only one person, for a fixed amount of money at a negotiated price, and then the company announces the deal. However, we should know that a SPAC is a more expensive method of going public than an IPO. In other words, the value of a private company usually is discounted more in a SPAC rather than in an IPO. According to SPAC data website, in 2020, $83.3 billion was raised through 248 SPAC IPOs, while in 2019, only $13.6 billion was raised by 59 SPAC IPOs. So we observe a huge increase in the number of SPACs in 2020. Why is that? One reason can be COVID-19. Due to COVID, many of IPO roadshows are taking place remotely. However, IPO roadshows are hard to do and less effective remotely. And there is more uncertainty and volatility in the capital markets, and uncertainty can affect companies' valuations by the market negatively. That's why many private companies try to go public through SPACs. The biggest SPAC in 2020 was done by Bill Ackman. He could raise $4 billion through a SPAC. Some other companies that use SPACs to go public and raise capital are Nikola, DraftKings, and Virgin Galactic. Thank you for watching this video.